This is a very rough chart of what the stock market has looked like over the last 100 years. Over the last 100 years, we've seen big stock market crashes. We saw things like the 2020 crash. I know this is just a simple sketch that I did, but we had the 2020 crash. We had the 2008 crash. We had the 2000 dot-com bubble bursting. We had, don't forget, the Great Depression. I mean, we had a number of crashes that we've had over the last 100 years, but despite the market crashes, despite the recessions, the stock market has gone up. It just didn't go up linearly. And the reason why so many people say that the stock market is scammed, the stock market is rigged, is because they buy here. They buy when all you hear on the news is everybody is making money. And people are making so much money, they're getting rich that your taxi driver is retiring and they're living in Hawaii because of their stock market portfolio. So that's when people come in and then things start to go down. Now you start to panic, you sell. Maybe you bought on margin because everybody says if you just use debt, you can buy so much more stuff and get even richer. And now you end up selling here, you lose money, you think it's all a scam, it's rigged. All those things happen. Then you hear about people getting arrested and a lot of bad things happen on the way down. That's when you hear about all the fraud and the corruption. Well, the reality is, despite all that, the markets have gone up. It just doesn't go up linearly. So what you need to understand now is that these ups and downs are a part of the economic system. And the wealthy, the financially savvy, what they understand is that these create buying opportunities. Because now you could come in and buy great investments at a discounted price. When the 2020 crash happened, the financially savvy were buying stocks for 30% off because in a matter of days, the stock market fell by 30%. When the 2008 crash happened, the financially savvy were buying real estate for pennies on the dollar, while everybody else was losing. When the 2000 dot-com bubble burst, everybody was selling, but the financially savvy were coming in and buying for pennies on the dollar. Again, you got to be financially prepared. You got to have money to invest. You got to have the financial education to analyze your investments, but you also need to pay attention to what's happening because these things can create opportunities. And now you have to know your strategy and blend the strategy with the markets. If you were just dollar cost averaging, you're just investing every week, every 2 weeks, every month. That's what that's called. You're investing into these funds and you're doing it on a passive and automatic system. That's called dollar cost averaging. The only thing you change is when markets go down, you buy more. That's the only thing you change. You don't turn it off. Because what the majority of people do, which you don't want to do, is when you see these downturns, people start selling out of their 401ks, they start selling out of their lifetime retirement accounts. That's not what you want to be doing. You want to use this as an opportunity to buy even more, not to panic sell. So you got to be able to stay calm, which brings us to number 5 now. How do you scale your wealth? There are 3 factors that will determine how wealthy you will become. TRM. T is time, R is return, and M is money. How much money you invest. The one factor that we cannot control is how much more time that we have. And so everybody will say, I wish I would have started investing 10 years ago, 20 years ago, 30 years ago, which is fine. We cannot change that. So you cannot change the time besides the fact that you can start investing sooner rather than later. The next 2 factors you have more control over is the return and how much money you invest. These 2 factors will determine how wealthy you will become, which means if you want to become wealthier, you want to get a higher rate of return and you want to potentially invest more money. How can you invest more money? Well, you can spend less or you can work to earn more. Pretty simple, right? But there are strategies on how you can spend less money. There are ways to find some extra dollars that you can squeeze out of your budget that doesn't really cost much on your day-to-day life. There are apps out there that can help cut out subscriptions. Go through your bills. See if you can negotiate some of your utility costs lower. If your internet bill keeps getting more expensive year after year, if your phone bill keeps getting expensive year after year, call them. Ask them to negotiate. There are ways to cut your bills lower and get the same service. That way you have some extra money without sacrificing anything. Maybe cut down your car, cut down your home, cut down the vacations. There are sacrifices that you can make. Maybe work to get a second job. Maybe work to get a third job. Maybe work to start a side hustle. Maybe work to start a business. The whole idea here is you're making more money so you have more money to invest. But you can also work to increase your returns. And there are 2 things that you can do here. Number 1 is you can work to increase your returns by increasing your financial education. That might mean now looking for a little bit more sophisticated investments. Investing in individual companies, if that's something you're interested in doing, learning how to read financial statements, learning how to read an income statement, a balance sheet, a cash flow statement, studying the companies, investing in your own education. But this could also mean cutting down some of the fees that you're investing in. If you invest in a 401k, did you know that your 401k has a fee? If you didn't, I hate to be the bearer of bad news, but About 90% of Americans don't know that the 401k has a fee. So what I want you to do is go to your 401k, see what funds that you're investing in, and then look at the expense ratio. That expense ratio is the fee that you're going to pay on your fund. The next thing that I want you to do is see, are there funds that can get you similar returns that have lower potential fees? Because the lower fees could end up saving you a lot of money. For example, do you know how much a little 1% fee is going to cost you over the course of your investing career? It could end up costing you about $250,000, assuming that you make a median income. Why? Because a 1% fee isn't a 1% fee that you pay today. It's a 1% fee that you pay on every dollar that you invest, for every year that your money is invested, and every dollar that your money makes for the course of investment career. So if you were going to have $1 million in your investment portfolio, that 1% fee could eat up between 20 to 28% of that, $250,000 going straight to your money manager in the course of fees with a small 1% fee. So what I'd like you to do as your homework for this video is go play around with an expense ratio calculator. They're all over Google. Just Google expense ratio calculator, find that. Then open up your 401k account, see what your expense ratio is, and now take that expense ratio number and plug it in. Then look at the different opportunities that you have to invest in with your 401k, and maybe you can find a fund that will give you a similar return, maybe even a higher return with a lower expense ratio. Of course, nothing is guaranteed. You may want to consult with a financial advisor if you want some specific guidance, but these are things I want you to think about, because now if you want to build wealth, it's TRM, time return money. You can't change the time. You can improve your returns by investing more aggressively or potentially cutting your returns, or you can work to invest more money. These are the things you want to think about as an investor. That way you can actually build wealth, because we have seen the markets grow by around 10% a year for the last century. We know that over the long term markets grow. We know that there are market crashes. We know that there are opportunities. But the people that are just chasing the next hot stock often end up losing. But if you stop doing the attractive thing and start doing the boring thing, it is a proven way to build wealth over the course of your career and not really have to take on much stress if we just let the markets do their thing and let the economy do its thing. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.